only video, and that trading foreign exchange is dangerous and you should ask the advice of an independent financial advisor, all right, before trading foreign exchange. This is just an educational purpose video only. If you would like to read the entire risk disclaimer, please send a chat or email to our customer service at Admiral Markets, and they will send you this risk disclaimer. All right? So thanks for your attention on that. And as I said, this is Admiral Markets. We've got some great contests going on here at Forex Ball. I hope you're joining. It's always fun to join with these contests. But there are also other great stuff like buying and selling direct from the MT4, markup depth, and great spreads. All right, so take a look at that. That's really some cool stuff. They got also Elliott Wave analysis. I think that's worth taking a look at because we're anyhow talking about Elliott Wave, so I think that's fair to mention here right now. Besides Elliott Wave analysis, by the way, Admiral Markets has fundamental analysis and technical analysis as well. All right, so let me switch this to English so that everyone can follow the language. That would be quite useful. And I just wanted to quickly show you here, because we're going to be talking about the Elliott Wave analysis, that there is analysis here on the waves every day. All right, so take a look at that. That's great stuff to see and to look at, and it's quite useful because we're going to be talking about Elliott Wave. So, all right, cool. So, before we start, if anyone has any questions, comments, clarifications they want to get from me regarding Elliott Wave or anything else from trading, please let me know. Send the chat and I'll get to your question or comment as soon as I can. All right, no problem to interrupt me. So, today's goal, explaining why Elliott Wave theory is a very useful tool for explaining and predicting market psychology. All right, okay, why is Elliott Wave theory useful to predict the market environment? All right, so today's agenda, it's going to be an introduction to the Elliott Wave theory. I have to touch, of course, these basics. What is it, and what could we see? What kind of patterns does it give? For those of you who already know that, I ask for your patience in that. It will be something that you already recognize, but I think it's good for those people maybe who have less background knowledge in the Elliott Wave theory that we slightly dip into the theory. Of course, we can't explain everything because the webinar would be too short, but we'll go into that a bit. Then we'll take a look at what kind of moves we normally see within the Elliott Wave theory. Then we'll look at the market psychology, and then we'll be tying that psychology to the Elliott Wave theory. All right? So, some questions, as for those of you who already have joined me several times, I like to ask you some questions actually before we start this webinar, and most of the time I probably ask too many questions, but for those of you who like to type, do you use Elliott Wave in your current trading? So I'm kind of curious. That's probably the number one question from my side. I'm just curious who out there, whoever is watching this webinar right now, do you use that Elliott Wave in your trading? Do you use it like a lot or just sparingly or not at all? So if you have time, that would be great. I'm just curious. So just some other questions that are connected actually to the first one, like do you think it's nonsense? Do you sometimes get discouraged if you're using it? All right. So an introduction. Oh, I got some answers already. That's great. I see I've got 4 no's and 2 yeses. All right, cool. So that's about 1/3 to 2/3. The nays are winning at the moment, so that's 5-2 for the nays. So we got some more 6-2. Okay, interesting. Very interesting for me. 6-3. Okay, it's like a football match where we're keeping score. Very interesting. We got 8-3 at the moment. Thanks for your answers. It's appreciated. I like to get feedback from you. Cool. So let's try, for those of you who like it, we're going to give an attempt to show why Elliott Wave Theory is going to help you in your trading, for those of you who said no, because that's kind of the goal of this Elliott Wave Theory, to show the benefit of this tool. Basically, the Elliott Wave Theory is named, of course, after the founder, Mr. Elliott, Ralph Nelson Elliott, who lived at the end of the 19th, the first half of the 20th century. And basically, he was looking and he discovered repeatable and recognizable patterns in the market. And he found that quite interesting, that these patterns are repeating, and they seem to fit certain rules, and they seem to oblige to guidelines. And when he pieced it all together, he said, well, I can use this theory to analyze market cycles and then also predict and forecast trends and movements in the market. Now, the Elliott Wave Theory was maybe a bit brushed aside, and these two, Frost and Fractal, basically brought it back to life a bit in that regard, and they wrote a book, The Elliott Wave Principle, in 1978, and it got a bit popularized after that. All right? So, basically the market prices, they unfold in patterns, and these patterns are called Elliott waves. And these patterns are basically, very simply put, 5- and 3-wave structures. All right? So basically, if you're going in an uptrend, you would have 5 waves up, and then those 5 waves would be corrected with a 3-wave structure after those 5 waves. That's the very simple and basic wave structure that you can expect. And these are these patterns. All right? Now, basically, these 5- and 3-wave structures unfold in impulsive and corrective characteristics, so or types of waves. Let me say it this way. So what would happen is that, typically speaking, with the trend, but also sometimes counter trend. For example, if the trend is up, the up moves would be impulsive, would be quick, would be one-directional. So you would see candles close towards the high. You would see a lot of bullish candles, not that many bearish candles in this up move. You would see candles bigger sized and the down candle small. And the corrective move is basically more a mix of candles. The closes are not so close to the extreme, and there's more of a unclarity, not a one-directional movement in the market. All right, so that's to give you an idea of the difference between impulsive and corrective. Now, these 5- and 3-wave patterns, basically the 5-wave pattern in itself is an impulse, and they're numbered 1, 2, 3, 4, 5. But the thing is that all these 5 waves are not necessarily all of them are impulses. Waves 1 and 3, 5 are impulse to do with the trend, normally speaking, and 2, 4 are corrective within this 5-wave impulse. And the correctives are labeled with letters, most of the time A, B, C, sometimes D, E if it's a triangle, or W, X, Y if it's a combination. Okay, those are kind of details, but letters in any case. Now, most of these are correctives, but sometimes A and C are impulsive. All right, so we have this 5-wave and 3-wave structure, and we know that they're impulses and correctives, and that we label them with numbers and letters. All right. Now, all these waves basically form higher and lower degrees of structure. So you could, for example, on a 1-minute chart, you could see 5 waves up and see an ABC all on a 1-minute chart. If it's if the market is liquid enough, like a euro dollar for sure, those waves 1, 2, 3, 4, 5 would be wave 1. The ABC would wave 2, and then the market could be making a wave 3. And that could be then visible on the 5-minute chart, for example. On the 5-minute chart, that would be wave 1. And when you finish a 5-wave pattern on the 5-minute chart, that would become wave 1 on the hour chart, for example. So every wave is part of another wave, all the way from the bottom, all the way to the month chart. And if there were a quarter chart, you know, you have cycles to to a very high degree, to such a degree that it's not even usable for us as traders, to be honest. And then it doesn't become interesting for us anymore. But all of these structures are part of other structures, and then within those structures there are other structures or waves. So it's all interconnectable or part of each other, if you understand what I mean. All right, so if anything's unclear, let me know, but I think the best is a chart, by the way. So here's a clear example of the euro-dollar daily chart. This is dating back from actually a year ago to summer last year, to July, end of July. And you can see now what I mean with impulses. This is a downtrend, and the trend is a down, so the impulse is down. And the wave 1 is an impulse, the wave 3 is an impulse, the wave 5 is an impulse. And you can see why it's an impulse, because it moves fast downwards. It has a lot of bearish momentum. It's just one directional. While the corrections take a bit longer, they don't move as much to the upside as the down impulse goes to the downside, etc. Okay? And you can see that within this 5-wave structure, wave 1, 3, 5 are impulses, 2, 4 correctives, and wave 3 typically is the biggest momentum, the biggest power, the most selling or buying, depending on the trend, of course, occurs there. It's the biggest movement normally in wave 3. So you can see that within wave 2 and 4, within wave 2, I label a grayer kind of ABC to show you that there could be bigger corrections within a wave. So you can see that that corrective has an ABC structure to it. And then also within wave 5, I gave you an example of a clear extended 5 waves within the 5th wave in that last part. Then after that 5-wave correction, we can expect an ABC, and you can see we're making ABCs to the upside, ABC for wave A, wave B, then an ABC for wave C, etc. So this is the typical perfect example of a 5-wave structure with corrections and impulses within those waves, and a perfect example of some corrective patterns after that. All right. Now this 5-wave, depending on the higher time frame, it could be a wave 5, a 3, 1. We would have to zoom out to a week chart to analyze how those 5 waves fit within the higher time frame to understand what is going on. We can't see that here. If we want, we can take a look at the live chart, but that's what we'd have to do. Then again, if we wanted to look at the structure within these waves, within wave 1, within wave 3, within wave 5, within wave 2, within wave 4, we'd have to zoom into the 4-hour chart to kind of analyze and understand what the structure is of the Elliott Wave Theory within those waves. And then we'll get subwaves within wave 3, for example. Okay, so I hope that's clear. Basically, these waves within waves, it's called the fractal nature of the market. Okay, and you see a lot of things in nature are fractal. For example, the 618 fib is always actually can subdivide in another 618, and it keeps on going. Or the tree, for example, is a fractal because it keeps splitting in a kind of a same divisional manner. So there are a lot of examples. I'm not too good in this part, but there's a lot of confluence there between markets and nature regarding not only the fib numbers but also Elliott Wave. A good book to read is Bill Williams' book, and he dives into actually the resemblance of nature and market, and it's very interesting. All right, Trading Chaos is the name of the book, by the way. So with that being said, as I already said, impulse waves mostly with predominant trend, corrective waves mostly against the predominant trend. We already talked about that. But there are many trends or many levels. So we want to take a top-down approach. What I do is I just start at the week chart and I move down mostly to an hour chart, sometimes 15-minute even, depending on what I'm trading. So what you want to maybe do, depending on your experience level, is maybe do 3 time frames, for example, at start, and once you grasp 2 or 3, maybe you can then expand your scope. Now, just one thing regarding these impulses, as I already said, not only are there impulsive impulses, you also have corrective impulses. A wave 1 and a wave 5 don't have to move that fast. They can sometimes be quite slow, and then they're more corrective pattern. those are normally like rising and falling wedges types of movements. Those can be officially impulses, but they're kind of corrective. The same for correctives. They don't have to be corrective correctives. They can also be impulsive corrections. For example, a fast down move of a uptrend could be an impulsive correction. All right. So I have to get a grasp of that because I think it's a good thing. What I'm trying to basically trade are more impulsive patterns, right? So yes, with the trend, trading with the trend is a good approach because it will give you a higher statistical chance that you will grab an impulse, but sometimes they're good impulsive corrections as well. So it depends. It all depends. But let's take a look at the next screenshot and you'll get an idea maybe what I'm looking at. So this is the euro-dollar 4-hour chart, and we can see already I labeled a typical classical 5-wave to the upside. By the way, I should mention that there are all kind of rules and guidelines connected to Elliott Wave, how to label 5 waves up, 3 waves down, 5 waves up, etc., or corrective. Sometimes corrections get very complicated and expanded, and that's actually where traders have the most problems with, because if you stick to trading the impulses, it's quite straightforward. It's going one directional. But corrections can expand, can become very complex, and can even turn out to be more complex. So that's actually where the most toughest job is for the trader. And if we are able to actually avoid those corrections, you're doing a great job. So there are a lot of rules and guidelines I didn't mention because it's just, you would have to look at the rules and guidelines yourself. There are quite a lot of them, and the best is to look, somewhere online, find those rules and guidelines, write them down, and try to put them on the chart, and maybe, print them out and stuff like that. Okay, so 5-wave up and 3-wave correction. One of those guidelines, just to give you a hint, is, for example, wave 3 tends to be the longest. For example, that's just a guideline. But wave 3 is never the shortest, and that's a rule. Just to give you a glimpse of what kind of rules and guidelines there are. Wave 3 is never the shortest, is a rule, and is usually the longest. That's a guideline. Okay. So now let's go back to the topic of impulses correctives. We have this 5-wave up and 3-wave down. I think already visually you can see what parts of this are impulsive impulses, what parts of this move are impulsive corrections, what parts are maybe corrective impulsives, and what parts are corrective correctives. All right, I will show you in the next chart. But I think that you already have an idea, visually what you could expect, right? I got an answer here. That's great. I didn't expect that, but let's see. 135 wave 2, 135 2, and then 24 CC. AC, 135 impulsive, understand? Great job. 24 corrective, AC corrective impulsive, and B impulsive corrective. Well, the B is not an impulsive corrective in my opinion here. If you're talking about this, that's more of a corrective because it's to me it looks like a small, but I mean it depends on the time frame. I mean if this would be maybe a 50-minute chart, this could look there's a part that probably looks impulsive. So it all depends, of course, on the degree and what level you're looking at. I'll give you that. The rest looks very good to me, to be honest, because indeed A and C, these are corrective impulsives. Or impulsive corrective, sorry, and the rest are indeed more of an impulse. So let's take a look what I have. But thank you for that that attempt. That's great. So, and indeed, I have a question. Wave 3 is always impulsive. That's correct, Lubin. Yes, wave 3 of 3 is always impulse. Actually, all wave 3s are impulsives in total. And wave 3 of 3 for sure, indeed. Absolutely. And no sound on mobile version. I'll have to. Does everyone have sound? Just want to check. I think it should be okay. Yes, okay, I got confirmation from someone. Great, thank you for that. Sounds okay. Okay, I'll just quickly write that person so that he knows about it. Okay, thank you for the confirmation. So let's take a look at what I have for you, what I came up for you. So basically here, in general, of course, Athanasia, you're right. Wave 3 in total is definitely an impulse, and wave 1 and wave 5 are as well. I kind of was looking at the moves within the move, and then you see that within wave 3 you have definitely impulses, right? But then within wave 3 you have some small corrective corrections, right? Because those are just actually like waves 2 and 4s within the wave 3. All right, so that's definitely impulse. That's the purple box and the black box within wave 3. Okay. Then we have wave 1, which is a corrective impulsive, relatively. I was thinking this is subjective. I mean, it's not a black and white thing, right? It's a bit of a grayish area. Then in wave 4, I was thinking that looks quite like an impulsive correction, if you see what I mean. You can see here that this is quite impulsive. So that looks more like an impulse correction on this time frame in any case. And then I was thinking that the wave 5 actually looks more like a corrective impulsive. I don't know why this should be blue. I don't know why I have it black. Okay, doesn't matter. Because maybe I was thinking it's still corrections. Okay, doesn't matter. Depends how you look at it. But you can see that these purple boxes are definitely a bit more impulsive, just like these, right? And of course, this is definitely an impulsive correction. That's a corrective pattern because it's a C wave, but it happens in a very fast, quick manner, a lot of power, so that's why it's impulsive correction. All right. So let's see, we got a question. Isn't wave 2 an impulse correction instead of an impulse? Well, yeah, it depends how you look at it. I mean, this is quite a deep correction here of this entire wave 1. It goes back to, for example, a 786. Also, if you look at the candles, they are showing quite of an impulsive, typical impulsive features. So to me, this was an impulsive correction. Excuse me. This is, I have here impulse. I think I was. Let's see. Yes, you're right, Lubin. That's this purple box is meant for this part, and this part is indeed the impulsive corrective. You're totally right. Good eye. Good catch there. Thanks for that. You're totally right. Didn't notice that. So Lubin is totally right. Of course, the left part is an impulsive corrective, and then the next part is an impulsive. So that's why sometimes you see in the market all of a sudden an impulse down and an impulse up. That's the explanation why that happens, right? So I think enough said on these impulses. Questions of our focus. All right. Why do markets move as they do? What are the inner driving forces of the market? Does Elliott Wave Theory explain market moves? And how does the market psychology play a role? All right. So I'm going to show you that the Elliott Wave is a nice explanation to show you, why does the market move like it does. It's a driving force of the market, and then basically it just explains that market psychology. All right. So basically, in my opinion, the long-term market direction is driven definitely by economics and fundamental factors. If you're looking at a week and month chart, you're talking about the money supply, the printing of money, quantitative easings, trade balances, interest rates, all this stuff. Inflation rates, you name it. Yes. But these do not explain the factors necessarily or the movements of up and down when the currency is going to a certain direction, even if there is a clear direction. For example, when the euro-dollar was moving to the upside from 2000 to 2008 in a five-wave pattern clearly to the upside, you had ups and downs. Now, the fundamental factors might change a bit, per quarter or year, but these long-term factors don't really change that fast. To explain all these moves up and down on a 1-minute chart on a 5-minute chart. All right, so basically what is explaining these moves up and down, it's mass human psychology. And Elliott Wave identifies extremes in that investor psychology. All right, that's what it all boils down to. It's very simple. That's the main focus. Okay, so let's take a look at the next one. Oh, did I skip one? Yeah, sorry. All right. So here, for example, I think this is the euro-dollar month chart that I just talked about. And you can see the euro-dollar is in a long-term uptrend, but prices do not move in one straight line. All right, just a simple example of these ups and downs, but of course we see it on every time frame. We see retracements and moves up and down no matter what the trend is. All right, now if basically for those of you who like theories and are like into that, for those of you who know, there is a theory of market efficiency that says that investors cannot earn more than the average if the markets are efficient. They're assuming that the markets are efficient, and therefore they say that you cannot earn more than the average investor by using technical analysis because information is perfect. So if there's any chance that there would be an opportunity to earn more, that people would be aware of it and it will become not an opportunity anymore. But for those of you who like these theories, but many regard the markets not as efficient. Why? Because of the fact that these human and investor psychology create these extremes. And basically traders, if you play it smart enough, you can profit from these extremes in price. So if the market would be indeed efficient, you would not have these extremes because there would be probably no emotions in the market, because then people would be rational to realize that it's not good to buy here or sell here, and it would be perfect trading. Of course, we know that perfect trading doesn't happen. There's a lot of emotions going on in the market, causing actually a incorrect assessment of a commodity or whatever, of a currency, and therefore you get extremes. If it would be perfect, probably the market would have more of a bell-shaped, for those of you who like math, like a statistical kind of movement. That's the most of the price would be close to one standard deviation, for those of you who like that. So, but it's not true. We all have these emotions and trade on them, even though we try maybe not to do that. So in any case, even if one person manages to control their psychology, we're talking about a group psychology, of course, of millions of participants that form a total collective crowd psychology. And that collective crowd psychology moves between optimism and pessimism in natural sequences. And that's when market prices unfold in patterns, in Elliott waves. All right? And that's when we get these waves within waves and the natural fractal net. And then we see the fractal nature of the market. Okay, so as I said, these patterns are driven by market or crowd psychology. And basically, Elliott wave is nothing more or less than a guide to explain these effects of psychology on price. It's giving you a guideline of what, a heads up, what could happen. All right, and yes, it is not easy. And that's why I think people get discouraged, because it does take practice. It does take a lot of, good amount of work, good amount of practice. You have to dig in and learn a lot of stuff. But once you get through that phase, it will enrich your trading. And it's a difficult process. I'm not saying it's easy, and I can see why people get discouraged, because it's as people say, it's easy to explain in retrospect and actually use with a predicative, like future, with a future value. That's true, but it will get better as you practice it more and more. So basically, crowd psychology is affected by all participating actors, right, in the marketplace, and this repetition occurs in the marketplace because we humans are affected by the past and experiences, and we act on those past and experiences. We use the past as a reference, and that's why those patterns will reoccur again in the future. All right. Elliott wave, by the way, its shapes are not always the same, but its character, or the shapes, are different sometimes, but its character not. So although the wave 1, 2, 3, 4, 5 will always have similarities, not every wave 3 will be the same shape. Yes, the wave 3 will have the same kind of character in the sense that normally it would be the longest, it will never be the shortest, but its exact shape could differ. One wave 3 on a euro dollar could look a lot different than the wave 3 in the Aussie on 1 hour, right? These shapes are going to be different. And just to give you a simple example, we all humans have fingerprints, but each print is unique. And I think that's the same with Elliott wave. All markets have waves, but each wave is unique. So to understand why that is, just look at our own fingers and you understand what I'm explaining. All right? So now let's take a look at a quick, I'm running a bit behind, I'm afraid. There's a lot to explain. But each of these waves has its own signature, basically. All right? Each of these waves counts, wave 1, wave 2. They all have their own specific interpretation and psychology of the moment. So although the shapes will be different, as I said, the psychology behind it are normally quite similar. So the characteristics now of these wave psychology is as follows. All right? So wave 1 is typical an impulse, you're already, for example, in a trend in the opposite direction. It's maybe been going on for a while, and normally on the news you typically hear that this trend will last forever, stuff like that. And then you see suddenly a impulse where the market snaps back in the opposite direction of the trend. And you see a more rapid movement to the other side than you have ever seen before, right? Instead of the more corrective sides. Let's assume an uptrend so that I can give a side to it, all right? Otherwise I have to think about that all the time. So we're in an uptrend all the time, and eventually, we get a wave 1 to the downside because the wave 5 has ended, the upside is over, and that impulse to the downside is a lot more than you've seen before. Until now, the downside was very slow and didn't move too far, and all of a sudden we see a burst of energy going to the downside. Then wave 2 normally is where we still get a very big push up. Why? Well, because the uptrend is still in many traders' mind. They still see it as an uptrend. They see this down move as a dip, and then they are looking for that upside. And that's where sometimes traders get caught, actually, is they're expecting a continuation of the trend. But that's where you see either maybe, or it could be a bigger ABC or a total reversal in the 5-wave pattern. But that's where you then see the wave 3, where this wave just keeps on going and going. There's a lot of optimism, or pessimism in this case for the downtrend, but okay. There's a lot of optimism for that direction, let me say it this way. And there's a lot of power and strength, and everyone catches on eventually that the trend is reversing and it just keeps on going, going, going. That's why wave 3s are very powerful and a lot of momentum. Wave 4 are therefore quite shallow because it's clear that the direction is one-sided. There will not be much movement in the wave 4 typically, most of the time sideways. It normally takes quite long in time. Everyone's waiting for that 5th wave and kind of on the sidelines till that happens. Then you get the 5th wave. Then the last people who missed the first 2 waves get on board. This wave, therefore, normally tends not to be the longest because big market players are already then positioning themselves at the end of wave 5 for the reversal, just as they did at the top when they were anticipating the wave 1. All right? So the ABC is somewhat similar as a 1, 2, 3. Basically, the wave A is where you get that first correction. Wave B is then the correction of wave A, and wave C is then the 3rd correction with sometimes a lot of power. It depends. Sometimes you get flat corrections. Sometimes you get very impulsive corrections, as I said. These are impulsive corrections, or you get corrective corrections. In any case, trading the waves 1, 3, 5 is always the best for you because those are a higher degree of certainty that they're going to go in your favor. trading corrections, you could bump into an impulsive corrective and be lucky, but you could also bump into a corrective and you're stuck in a trade, and it could take long, you could lose, and that's not the area where you want to trade it. All right? If you try to focus on wave 1 and 3 and 5s, that's where you have the higher probabilities. If you trade the impulsive FC, that's just a nice bonus. Otherwise, be very careful with all corrections because they can be very complex and very difficult to trade. So that's a bit of a psychology here behind what drives the waves and what are the investors kind of thinking when in those waves. So here's just an example of a chart where you have 5 waves up, 3-wave correction, a wave up, 3-wave correction, 5-wave up, correction, 5-wave up, and internal lines as well connected to those. All right. Here we have another example of the euro-dollar day chart where we can see the, now I understand, sorry, I have to go back. This move up, all right, so we see 5-wave structures, 3-wave up, 5-wave structures, right? This whole chart is within the green box here. So you understand, this is a 4-hour chart. That whole 4-hour chart fits within this green box. So if you zoom out from the 4-hour world, you see that those 5 waves up on a day chart are actually corrections. So that's how you can piece together that information. For example, here on the euro-dollar, you can see that actually the 5 waves up were a wave A, then a wave B, and a wave C for wave A. I'll show you where I mean. Sorry. Let me, here, these 5 waves up were for this, then 3 waves down for this, then another 5 waves up for C. That makes ABC for wave A. Then we get a bigger wave B, and then we get another A, B, C for wave C of wave C. And this A, B, C in turn is actually again part of a bigger wave C, this red wave C, which already had a red wave B and a red wave A. And that's why I was already thinking and trading that this is going to be somewhere in here is going to be a reversal. I thought a bit higher, but once this move down happened, I already realized that this is an impulse and a turnaround here on the euro-dollar. I wasn't all too sure if it would happen here. I expected actually 138.50, the end to be at 138.50. That didn't happen. But once we got this move down, I realized we're switching gears, and indeed we got a huge, relatively good move down all the way to the 129.50 area, which is still 650 pips away from that top. I didn't catch the exact top, but I did realize that this is the signal for us, this down move here, that we're switching gears. Now, I would like to dab into maybe this question. If everyone would know that the Elliott Wave Theory works, would it work and why? You see, the question is, of course, interesting and definitely, worth talking about. And the reason why I think it's not that important, though, in my opinion, is that the marketplace is just gigantic. And everyone is going to interpret, even if everyone would use the Elliott Wave Theory, which by far probably is not true in any case, not sure how many people use it. I personally think that big players use it, in my opinion, but okay. But not everyone uses it. And if everyone, even if everyone would use it, it's just a gigantic marketplace. Everyone will have their own kind of view still, even with these rules and guidelines, for sure. And they're going to be also looking for different things within these moves. You're going to have traders that are looking at different time frames, different currencies, different entries, different setups, even when using the Elliott Wave Theory. So looking at the vastness of the market, of course, we know that how many trillions are not bought and sold within a day. So that's just not so that everyone would have one view, and so it doesn't work like that. Basically, price follows the path of least resistance. If you would picture a river where the the flow of the water is just going in such a way that it goes down in the most easiest way. All right? Picture yourself in your apartment or your house or wherever you live, and when you go to the bathroom, for example, you choose the path of least resistance. We don't know it, but we don't think about it often. Sorry, of course we know it. But the architect of our house, of course, built walls and doors, and we're not walking through the wall to get to the toilet. We choose the path of least resistance, which is to walk through the door and open the door first. Same is true for the currencies. The price is going to follow the path of the least resistance, right? If there's not much agreement, we're going to see corrections. At one point or another, the minority of the time, though, the majority agrees. That doesn't happen often. Maybe a quarter of the time, there's an impulse. And 3/4 of the time, the currency is actually correcting. The currency likes to correct. At one point of the time, the majority is going to agree, and that's when the impulse is going to have the path of least resistance. All right. Yes, and there's a good add-on here from a webinar viewer here. Even if everyone would agree in view of the waves, the human nature is like it is. Fear would have stopped them from entering, or greed would blind them, even if the reason will tell them something different. And this is a perfect comment. Thank you so much, because next week we're going to actually have a webinar on fear. All right? So that I definitely encourage you to go there, because I really think that's a super important topic. So if you have the time, join that webinar next week. I think it's very useful. So the path, and I think this, to come back to this topic, this is a very interesting realization. Please think about it when we finish this webinar. Realize what it means, because at certain point, what is the most logical thing for the currency to do when it approaches the top? It's going to get a bounce, because that's the path of least resistance. So it's a very useful concept if you start looking at the market in that manner. Now, all Elliott wave counts are most likely scenarios. All right. Sometimes the price goes elsewhere. That can happen, and it will happen for sure. And that's why we have invalidation price levels. All right, that's why it's important to realize at what level, once you know the rules and guidelines, is my count wrong. That's going to happen, and that's why it's important. That's why Elliott waivers have an alternative count ready, so that if their level is penetrated and invalidated, that they have a potential to understand that the currency is actually doing something else, and it's an alternative Elliott wave count that's standby. All right. So in that case, then the new count is ready. This is, for example, your dollar 1 hour chart, just to give you an idea. For example, when the currency moves to the upside, right here, and it's in this box, then if you would take any break of that trade, if you really want to be careful, of course, a stop loss on this sideways would, in that case, would have worked out fine. But the invalidation level is most likely this low. Same if you are in this trade. If you look at this box, the real invalidation level of this trade is that level. Same if you take this trade to the downside, the real invalidation level is probably here or here. All right, you get the picture. All right, so I'm going to take a look at some charts now. Luckily, we still have a bit less than 15 minutes, so I'm happy about that. Because you must be wondering as well, how do you count the other waves? Because that's, of course, the most difficult part. I hope that the psychology side, why Elliott waves is useful for interpreting the market, is clear. If not, let me know. If you disagree, let me know. If you agree, let me know. Just curious about what you think of my presentation, why the Elliott wave goes hand in hand, kind of the market psychology there. Just curious if you have time, a why, and, or question mark, not sure, for example, that would be cool if you have time. Now, of course, the greatest problem in reality and practical life is how do you count those waves? And that's, of course, a very tricky and difficult thing to do. Now, you could use the guidelines and rules to get an understanding of what could happen, but that's definitely, you need to know that. I mean, that's for sure. But it will not help you in all cases with predicting the right wave. My green lines, those are just moving averages I had on from a here, let's see, they're 50 and 200, but they were to prove something in the previous webinar actually. They're not necessarily connected or value to today's webinar, but using technical analysis basically with or moving averages, trend lines, but also a oscillator will greatly help you, using just technical tools will greatly help you with identifying what wave we are in. All right. For example, if we respect, I'll just give you an example. If we respect this 786 Fibonacci level, and we start to break out of, for example, this downside trend line here, for example, and we start to break these tops on the yen and start to make higher highs and higher lows, then we can already speculate on the fact that this is a wave 1, 2, and we're going to go up for wave 3, for example. You could also use this lower indicator here, the MACD, for that, to get an indication. For example, if you're crossing the zero line right here, that could be already the indication that we're going for wave 3, for example. Looking at the internal parts of this down move to discover if there's an ABC is another method. Looking, for example, to fib part wave A to see where wave B goes and see if wave C hits a target and turns from the target and is equal to a retracement of this wave up is also another clue that we might be going up for at least a wave C or 3. All right? The other thing you want to look at maybe is the strength of a move up. You can, for example, see on the MACD that this move up was very strong, right? Here. So if you see such a thing, and you maybe have counted 5 waves to the downside already, right? But here was 5 waves to the downside, and you see a very strong impulsive move up like this, for example, and the MACD is high, and you have within this move up, you go to the 4-hour and 1-hour chart, and you see 5 waves to the upside, well, then you can start speculating that this is a wave 1. Of course, the invalidation level, for those of you who already know the Elliott wave, is the bottom of this, right? For example, if you get then this wave 3 and you see that the MACD here is stronger than this, then you know that this is probably indeed a wave 3 and you're going up probably down for wave 4, and what you could expect then is probably a wave 5 left, and most likely wave 5 will give you that divergence with the wave 3 like this, all right, for example. So using the MACD in that case is also a very useful tool together with trend lines, fibs, counting, zooming in to the 4-hour chart and counting internal waves, moving averages for the direction, just your basic higher highs and higher lows. All that stuff will definitely help. Let me think if I missed something. Chart patterns, of course, right? You can see that this was looked like definitely like a wave 4 because it was just very choppy. All right. Let's take a look at the euro dollar maybe to give an example of something else. Let me take some off so it doesn't become too clustered otherwise. All right. We got some comments here that's very confusing to identify and classify the waves. When a wave is a wave and some are not even impulses, but corrections very confusing for me to understand it. Sorry. No problem, Gerardo. If you want more clarification on that, no problem. I will help people who want to know more. If you look at, if you send me an email, all right? I will type in my email address so that because I can imagine, I don't have time in this 1-hour webinar, to be honest, to explain everything. That's just impossible. I just can give you a certain indication of what I look at. But it's just too much to handle within an hour. I'm sure you understand it, of course. And I can understand that for many it's confusing. But once you practice it more and more, and once you use these tools to identify the waves, and once you see that those tools are working more and more for you to predict correctly, you will get more confidence in that. But that's not an easy process, and that's what I've said from the very beginning. But using these tools definitely will help. Let's take a look at, for example, the dollar index, euro dollar. You can see here, for example, let's take a look at the day chart here. This is that 5-wave down, for example, that we were having in that example. Does everyone remember? And look at, for example, at the MACD. All right? You can see here, wave 1. For example, here we have a very strong move down, 5 waves down, and we're moving in a ABC up, correcting this wave down, and then we dip down here under the 0 line. That's a typical wave 1, and then we get something like this, which is corrective of nature, and the MACD just that doesn't go beyond the upside 0 line. Oh, I lost it. Okay, and then we see that here we get again a crossover. All right, and a very strong move here in the MACD, which is typical for wave 3. Then we get a move back to the 0 line, which is typical for wave 4, and then we get a break of the bottom. All right, for wave 5, and we can see that we get divergence, which is classical for wave 5. So, these are things that definitely will help you with analyzing. And if we would then use our, let me get rid of this and this. Okay. So if we would use our classical tools, for example, if we would connect to wave 1 and 3, okay, wait, let me use a channel. Wave 1 and 3, and connect it to wave 2, right? Then you can see, let me make that a bit thicker. All right, you can see that you can see that wave 1, 3, and we connect it to wave 2, and we can see that's exactly where 4 made a turn. So these are all kind of, all these tools that you can use to make the best prediction possible. Oh, sorry, we got some questions here about the zigzag indicator. I don't use it personally. I don't use any indicators. I do the analysis myself. But it's something to look into for sure if you like. I don't do it. I just do it my own analysis basically. All right. So these are there's a lot of tools, and as I said, I just don't have enough time to go through all of them, unfortunately. That's why 1 hour is just too limited for that knowledge to be transferred. But I wanted to give you an idea of some of the tools I use. I wanted to give you an idea why the psychology explains market moves and how you can actually use these tools to make a prediction on Elliott Wave Theory. And sometimes, I'm not saying that every time it's crystal clear to me. Sometimes currency is in a situation that, I'm not too sure. It's kind of grayish. But sometimes I'm so confident of a certain behavior, just like the yen upside, the big up move upside, or the euro turnaround, or this, for example, this up move. After we completed this up move, I was so certain about this up move. So at certain points, I'm just very certain because of the tools and because of my experience and knowledge on Elliott Wave of certain moves, and that's of course the best moment to trade it. And when I'm a bit less sure, then I'm more on the sidelines, right? So I know that it's difficult for those of you who don't use it and still think that it's difficult to predict. You're probably right, to be honest, because this 1 hour webinar could never, give you that background, sufficient background to right away implement Elliott Wave without any problems. So it will always take a level of implementation from your side to get to know and learn this method. All right. Let's see if we have, I think, like 3 minutes left. This webinar will be like automatically stopped after an hour precisely. So if you don't hear me all of a sudden, that happened last time, it's not that I ended the webinar without saying goodbye. It's just that it's automatically finished after an hour. So if I already say goodbye and thank you already right now before that happens. Thank you for being here. I'm very happy with your attendance and hope that you see the value of it. So thank you very much. Look at the Admiral Markets, the contest going on. It's very cool stuff like that, and the wave analysis as well. So that can help you as well, right? The wave analysis on Admiral Markets. So before everyone leaves, there's still a few minutes. I just wanted to say goodbye so I'm not rude. For example, gold, I was very, 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 very confident of selling it here. And I write articles every day, and I posted this several times actually when this trade was happening live. So this is not anything in retrospect. This is not something that I said afterwards. No, no, no. I was writing it live and posting it for the whole world to see. So I was out in the limb there and taking the trade myself. So not only risking capital, but also my reputation by saying this is an absolute sell. And I was very certain, because of all the factors that I mentioned, that this is a wave 1, 2, and we're going on for a wave 3. And I targeted 1555, and I don't want to sound arrogant, but it went exactly to 1555. So sorry if I sound arrogant, I don't mean it, but I was very proud of that trade. All right, so that's just really a nice $120 trade here, and I was just very confident about it. It did take some time here. I sold it here and then here and here. I had several positions. It did take some time. It doesn't seem long here, but if you're in the trade and it takes a week, it does feel long. But then luckily we got that huge move down. So that was based on the other wave analysis. Why? Because I saw this as an impulse wave 1, this is a wave 2, this is a wave 3. Look at, this is the oscillator. It's one of the things you could use besides the MACD. And you see a confirmation here between wave 3 and wave 1-3. So I thought that the break of this bottom was very high likely, and I thought that this was the moment going to happen where we're going to break these bottoms. All right, so yeah, it depends. Some person thinks that it's ABC. It's possible too, definitely. It depends on your account, but in that regard, there are different counts possible, for sure. But in my opinion, I saw it as an impulse, so I counted it 1, 2, 3. But there's another person here who sees it as an ABC Culver. Basically, if this bottoms get broken, then my count would definitely be true. But if we get a uptrend from here, then Culver could be absolutely right. All right. So you're welcome, Ruben. I'm glad you like that. Culver is saying a wave 4 could not go into a wave 1. It depends. It also is possible that this is a wave 1-2, wave 1-2, and this is 3, 4. We get 3, 4, 5 further. Some people see this as a potential to go a bit deeper to 1400. In that case, this is not a 1, 2, 3, 4, 5, but a 1, 2, 1, 2, for example. And now we get the impulse 3, or this is a leading diagonal type of a wave 1 where price can overlap in a wave 1, but I don't think that's the most likely scenario. I think it's either a 1, 2, 1, 2 indeed. You're right on that. Thanks. That's true. Yes, I have many moving averages indeed. Yeah, I'd like to use moving averages as well. Absolutely. Let's see. Culver is thinking that this is an ABC and an X, and then he sees this as probably an impulse. For example, there's like A, B, C. All right, definitely a valid count, and it makes a lot of sense, to be honest. And this could be actually maybe even the preferred count at the moment, more than than mine, to be honest. But once this big bottom on the week chart, if it does get broken, then my count would definitely be in force. But until that bottom gets broken, Culver definitely has a very good point. All right. But because I do expect the bottom break, I already saw that as a 1-2-1-2. All right. Yeah, our long-term analysis is totally different indeed. But I do realize that this is a wedge, and at the bottom of the wedge we could find a lot of support, and you know, there could definitely be a bouncing spot right there. I do realize that, absolutely. But what I see is, what I was looking at was more like a wave A down, and then this as a B, C, and then downside. That's why. But it's, you know, both sides are definitely possible. Let's see, any other questions? WXY, indeed. Yeah, indeed, Lubin, because it's a combination. Very good observation there. So yeah, cool. I'm glad with all these comments. So you can see that not everyone has the same count, but even though Culver and I would have a different count, we both would have concluded that it's a sell here. So at sometimes you do have synergies between different counts. You still have the conclusion that it's downside at that point. So you know, that's the beauty, and of course the hard work that goes into getting this analysis correct. But it's very, very nice reward is the benefit. So you know, I hope you enjoyed it, and we're going to round it up now. Somehow the webinar didn't stop automatic this time. That's good. We got a few minutes extra. Thanks for all your comments. Thanks for being here. I appreciate it, because I know that a lot of traders, you know, are skeptical of Wave. So I do appreciate the fact that you took the time and effort to at least take a look at this presentation and see if you like it, and maybe you've learned a tip or two how to implement it better. If if you're still puzzled and you want a bit of more guidance, then send me an email and I'll try to help you out a bit. Okay? So thanks. Have a good rest of the day. Good trading, everyone. Tomorrow's NFP. Just be careful. Next week we'll have a good webinar on fear. I think you'll enjoy that. I hope so. And looking forward to see you next time. Okay? Cheers, everyone.
The organ